Okay. Um, okay, great. Yeah, it's on now. Great. Awesome. Awesome. Thank you, everyone. Just wanted to do a quick introduction. This is for the GOB network. If you're new to the GOB network, please check out the GOB network. I'll shoot a link in the Slack chat here shortly. We're essentially a global wiki that provides help, whether it's raising capital or uh, funding deals. We're a network to help you get there and all that for free. So Jim is the founder and we're all part of the members for most of us that's here. And today we have a special guest speaker today, Kyle Mitchell. He's a real estate entrepreneur and the best-selling author of Best in Class, which is a book on focus on asset management. Kyle focuses on multifamily syndications and currently has $107 million asset under management. He's also the managing partner of Vertical Street Ventures and the Vertical Street Ventures Multifamily Academy. Their mission is to combine high potential assets with a best-in-class asset management to deliver passive positive. He has a background in operations, management, and logistics. Kyle also has seen multi-million business, has a passion for doing the same in the multifamily space. Now, Kyle is going to cover two topics today. One is on how to identify partners, and the other one is on how to successfully close for your first deal. And Kyle, do you want us to hold questions towards the end as you go through your slides, or do you want to have the host help facilitate questions?
Yeah, I'm
in
happy
between?
to have the questions come in as they come in. We don't have to wait till the end. I'll field the questions as they come in.
Okay, great. I think I'm having some audio issues. So I'm going to turn off my camera. Kyle, if you want to take it over. And we also have two other co-hosts, Jim and also Dennis, that can help facilitate questions.
Perfect. Are you able to let me share my screen?
Yes, definitely. You should be able to do that now.
Perfect. All right, can you see that? Okay.
Yes.
Okay, perfect. Well, I appreciate everyone for hopping on here. Sorry I was a little late. I had the wrong link, so that was my fault. But appreciate your time today. And like Missy mentioned, I am going to be talking about how to identify the right partners and also successfully raising for your first deal. And so a little background about myself first. Some of you may know me from my previous company, Limitless Estates. You guys are getting actually a sneak peek. I'm actually merging my company with Vertical Street Ventures. This Saturday is when we're going to make the announcement. And so choosing the right partners and the right team is actually a topic that I know a lot about because I'm going through it right now. So I'm happy to be talking about it, some of the challenges that I've had and some of the things that I've learned along the way, and I'm happy to answer any questions on that. So a little bit of background on me. I am the managing partner of Vertical Street Ventures. My previous company was Limitless Estates. I've been investing in real estate since 2010. I started out in single family homes, like many who start out in real estate. And I got up to about 10 single family homes when I was investing. I still had my full-time job at that time. And I found out pretty quickly that it's difficult to scale in single family homes. And I wanted more scalability. I wanted to grow my portfolio. And I also realized that to replace the income that I wanted, I would have to have about 100 single family homes. And that just didn't seem like something that was doable or efficient. And so in about 2013, 14, I kind of stopped investing in real estate. I kind of want to hit the reset button and figure out another alternative. And I started searching on the internet, and it honestly took me 2 or 3 years to find out about multifamily investing. And at the same time, I was looking to exit my job. I was a regional manager for a golf management company, so my background is in operations and management. But I just got burnt out in that industry. And so one day I was searching online. I found an online course that I took, and I fell in love with the business model of multifamily investing. And so 11 months after I found that course, I left my job to pursue this industry full time, and I haven't looked back. So been in this industry for about 4 years now, full time for about 3 years. We currently manage and operate about 107 million of assets, and that is between the Phoenix, Tucson, and DFW markets. However, our main focus is here in Arizona. I actually recently moved here less than a year ago to continue to build our portfolio out here. So our main portfolio is in Phoenix and Tucson. Did write a book on asset management. So if you're interested in that, it's called Best in Class. And that's just got a lot of information about things that are not talked about enough. They talk a lot about raising capital. They talk about, education on getting your first deal, but there's not a lot of information out there on managing the asset once you close on it. And that book's kind of a step-by-step guide on how to manage your asset once you close on a deal. And then I am the founder of the Multifamily Academy that Vertical Street Ventures offers, and I'll talk a little bit more about that towards the end here. Okay. All right, so identifying the right partners. So I just went through this whole process with identifying the right partners, and it's a huge step to merge your company or bring on a partner. It's much like a marriage, right? You're going to be working with these people day in and day out, and it's important to take your time on that, and I'm going to talk about that in a little bit. But number one thing is to identify your strengths. Is what I would say the first key to finding the right partners is knowing about yourself first and where you're strong. Okay. For me, I like managing and being on the operation side and being more in the field than kind of behind a computer typing things out. There's different ways to find out what your strengths are. I'm a part of a group called Strategic Coach, and they have what's called your unique ability. And so we're actually going through the process right now of finding out what your unique ability is. And that's not always something that's very easy to identify, right? It's not like you can wake up and say, okay, my unique ability is this, and that's what I need to focus on. So there's different things out there like the Colby assessment, Strengths Finder. I got them written down, DISC assessment, but those are things that you want to take and find out about yourself to understand where your strengths lie. Because when you're looking for partners, I think when you're first getting started, it's really easy to partner with anyone else that is interested in the same thing that you are, right? Because you just want someone that you can bounce ideas off of, that you can talk to, that can kind of share in your pain, I guess you can also say, when you're first getting started in this industry, because you're learning through the whole process. And as good as that is to surround yourself with other people who are also like-minded and want to get in this industry, it does not mean that that person is the right partner. Partnerships are very important to take your time on and really evaluate what your goals are and what you want to do. So first step is to identify what your strengths are so that you can find partners that complement you in that area, right? So you will, once you have your strengths, you want to find, you will know your weaknesses, and you will be able to then find a person that can fill in those blind spots or weaknesses, right? So the next piece about this is, what are your blind spots and weaknesses? Where are you not strong? So for me, in our business with Vertical Street Ventures, I'm now in charge of acquisitions, underwriting, and asset management, right? And so I'm very strong in all those areas. And they're all things that I wake up and I'm motivated to go do on a daily basis. I like doing those things. I do raise some capital, but it's not my bread and butter, right? So my other partners are focused on capital raising now. So now that's a piece that is taken off my plate. I don't really have to worry about it. And it's not something that I'm great at. It's one of my blind spots and weaknesses. Believe it or not, I'm not an extrovert. I'm very much introverted. So talking with people day in and day out is a very exhausting task for me, right? And it drains my energy. And so knowing that, is a huge benefit because I can now focus on the item. I can now focus on the things that give me energy and get my best production out of myself, right? So identify your strengths, and then you know your blind spots and weaknesses, and you go find a partner that fits that in. A partner is not someone just a warm body. Okay, you should look at this from a very strategic standpoint when you're identifying partners and how that person is going to add value to the team, right? So I always say multifamily is a business. A lot of people, when they're first getting started in multifamily, treat it like just, buying a single family home, but it's very much a business, and you need to treat it like a business, and you need to run it like a business. And so when you're thinking about partnering, you should have some goals. I used to say 5-year goals, but a lot can change in 5 years. So I've cut that down to 3 years. What are your 3-year goals? And as you're talking to partners, you should make sure that your 3-year goals align, right? But my point on this is, if today you're just getting started in multifamily, and in 3 years, you would like to be sitting on the beach, taking vacations, spending more time with your family, then you're going to go about putting together your partners differently than if you want to be the CEO of an organization that is built out buying hundreds of millions of dollars of real estate, right? Because those are two very different things, and both can happen. And I've kind of gone through that transition. When I first got started in real estate, I wanted to have $1 billion company. And I wanted to be worth, $100 million. I wanted to be the CEO. And that has very much changed in my life now, to where I just want to be a part of a team that is growing, that is doing things the right way, that is giving our investors return while we're making an impact on our communities. But I don't need to be a part of $1 billion company, and I don't need to be running it, right? So those are two very different things now. I'm part of a team versus being the lead kind of CEO person. So what are your 3-year goals? Are you trying to get out of the rat race of your current job and just join a team? Or are you trying to build a $100 million, $1 billion company? And as you do that, you'll build out your team underneath that. So understanding where you want to be in 3 years is going to be really important to identify your partners, right? All right, and then be intentional. And it kind of leads to all of that combined there. Don't just pick a partner just to pick a partner. Take your time on it, and be intentional. You've got to be strategic about adding a partner, and making sure that they add value to you and that you add value to them. Okay. And when I say partner, it can be multiple people. We have 4 different people on our team that are the main partners. And I focus on, like I said, acquisitions, underwriting, and a little bit of asset management or business execution, I could say, while we're going through the value add phase. And then we have someone behind the scenes that takes care of kind of the paperwork on the asset management side, and also runs our academy. And then we have 2 people focused on branding and capital raising, right? We also have a partner on our team that is a full-time asset manager. So all those things are really important when you're building that out and putting in the right pieces at the right time. Okay, I can kind of stop right here to see if anyone has any questions before I go into the next slide. I know I said I'd take questions as I go. So if anyone has any questions, go ahead and just unmute yourself and fire away. Happy to answer anything.
I'm going to have 1,000 questions, Kyle, but I think most of them we can handle offline. We haven't spoken in a while. So just want to say how much I appreciate you talking about this subject. It's one that is extremely important. Most of us don't take it seriously enough, and most of us, quite honestly, probably struggle with it. I'm 63 and have struggled with it mightily my entire life. And so it's very, very important for us to have these hard discussions and hard questions very early on in the partnerships, and looking forward to seeing if you cover some of that in the presentation.
Perfect. Yeah, if you have any questions or want me to cover anything that I am not covering, please let me know. I'll go to the next slide then and kind of finish off this section, and then talk a little bit more about it. But this kind of goes into being intentional as taking your time. I think right now in the industry, there's a lot of people that, you have that Facebook effect where you see other people killing it. They're taking down property after property after property, and you're sitting here just getting started. Well, pat yourself on the back, first of all, because you're getting started and there's thousands and millions of people who are not. But take your time. Don't let Facebook or social media influence your business plan, right? It's staying the course and being focused. I think a lot of times people will just jump into things because they need to get a deal done and they don't think about the consequences. And that's the tough part. If everything goes perfect by jumping into this deal, you're going to be fine. But nothing ever goes perfect in multifamily real estate or in life in general, right? There's always going to be bumps in the road. And so you really have to take a look at it and say, hey, if this goes sour, what are going to be the consequences? If you just jump into a deal right now, you don't know the sponsor, you met him a couple times or her a couple times, you feel okay about it, but you haven't vetted them. And now all of a sudden the market turns and the business plan goes south. What's going to happen, right? Do you have that strategic alignment? Have you spent enough time together? Have you talked about what's going to happen in these situations, how it's going to work? Or did you just jump in a deal just to get a deal done to get started? Okay, so it's important to take your time. If it's going to take an extra 3 months, it's going to be worth it. Now, when I say take your time, I'm not meaning to procrastinate and also take 3 or 4 years, but take your time when choosing business partners, vet people out. It's like interviewing someone for a job, right? You want to interview several candidates to be your partner and vice versa, and spend some time thinking about who that person is and how they best fit your organization. Okay, and trust your gut. I think a lot of times you have a gut feeling that, you know, maybe this isn't the right partnership, and you just go with it anyways because you want to get your first deal done. You need that support, whatever it may be. And I just think it's important to trust your gut and when you're picking a partner. Okay. And then test run before committing. You know, in this business, the great part about it is that there are so many different pieces of the pie to get started in multifamily real estate, whether it's raising capital, it's underwriting, it's finding deals, asset management. There's so many more too that I'm missing there. But you can kind of pick and choose where you want to play in this game and join a team to test run it first, right? Work together on underwriting deals to start, then work on making offers to start. But at that point, you're not a true partnership, right? And so you're testing it out with one another. You're seeing how you work together. You're seeing if your strengths and weaknesses play off of one another very well. And you'll learn a lot more by test running it first before really jumping into a partnership. And I'll talk a little bit about a partnership that I ended at middle of last year. And, you know, I still talk to this person and we're still cordial with one another. The problem with that partnership is we didn't take a look at our strengths in the very beginning. You know, many of you know Gary, who was my old partner, and he,
right? In my situation, because I'm still trying to get acclimated to multifamily, I've done a lot of single fix and flips. I have owned single family for investment as well as rental purposes. But when you are talking about establishing the partnerships, I'm assuming you're referring to when you are basically working with those people to take down a lot of multifamily deals, not on per, I guess, multifamily kind of deal situation.
I'm actually talking about both. You know, there's a lot of partnerships out there that actually merge companies or work exclusively with one another. And then there's also partnerships where they work with each other on a deal by deal basis. But if you're working on a deal by deal basis, you know, I think what you're saying is maybe tough to test run that before when you're doing only one deal. But you can test run things by underwriting together. So what we do is when we're looking at a potential partnership, we will, number one, have a phone call. We'll try and meet in person together at a conference or whatever it may be, spend some time with one another. But also, if we have a deal, we'll share it with that person, and then we'll hop on a call and we'll go over the underwriting with one another to make sure that we kind of align in those areas. But the more time you spend with someone, the more you get to know them, you get to know who they are, their values, how they work, etc. You're never going to be able to vet someone out perfectly, but the more time you spend doing that stuff up front, the better, right? So regardless of whether it's on a deal by deal basis or a full partnership, you should be taking the time to get to know that person and not just going based off of the merits of their track record, because someone could be very successful in this business and a great person, but they just don't work well with you, right? Everyone's very particular in the way that they work, and everyone's looking for different things. And so that's where it's important to understand where their strengths lie and your strengths lie. I was mentioning earlier, Gary and I, we have a lot of similar strengths, and we also have a lot of similar weaknesses. And so I don't believe that we added enough value to each other on both sides. And so that's why our partnership didn't work out in there, right? And so we're both in the industry, we're still doing well, but it just wasn't the right partnership for me. It doesn't mean that he was a bad partner or I was a bad partner. It just didn't work out. And so breaking up a partnership it's draining and it takes a lot of time. And so I'd rather spend more time on the front end vetting out the partners than on the back end having to deal with unwinding it all. So yeah, I'm not sure.
Like this list that we went through to kind of figure out, like our strengths and weaknesses. And we kind of had we kind of went through this whole exercise. It was like a couple pages. Do you guys do anything like that? Like kind of figure out if you guys would match, based off of paper, or do you guys have any exercise like that you do?
Yeah, so we do DISC assessments, and DISC assessments tell you a lot about your personality and who you are and some of your character traits, and how you work. And so we've done that where we compare each other's DISC assessments or Colby assessments. So we actually had a strategic meeting in December, and we went over those types of things, right? What type of Colby profile do you have? What type of strength finder do you have? For one partnership, I forget what it was, but what the assessment was, but we all did it and evaluated them to see if we would work well together. Those are not always perfect, obviously, but they do help out quite a bit. So yeah, we've definitely done those types of things. And going through that process, you not only learn a lot about other people, but you also learn a lot about yourself, which is one of the most important things when you're getting into a partnership. I think not a lot of people fully understand what their strengths are, what they really love to do, and where they're the most, strong and efficient. And therefore getting into partnerships that when you don't know yourself, it's kind of like a marriage, right? You need to know who you are first before you get married. You can't rely on your significant other to build that person up in you. You need to really know who you are first. Same with partnerships.
Okay, yeah, great. I mean, because the question that we would ask is kind of like our values and stuff like that, and our vision, and that's kind of what made, it went more deep. Kind of, it kind of, like you said, like a marriage. It kind of basically explains where we're from and kind of our backgrounds, and then kind of to present. So it kind of gave us a more in depth, with those type of things that you're saying. The disc. What did you call it? The disc.
DISC assessment. Yeah, absolutely. You want to understand your mission, vision, and values. And that's something that, when you're making your mission, vision, and values, it's easy to say those are really your mission, vision, and values, but do you live by it, right? Are you accountable for it? That's a big thing. It's easy to say that we want to, help our residents and do everything the right way, but do you really when the going gets tough? And are you able to have those tough conversations? And so those things are really important. And a lot of those things you don't find out until you get put into certain situations. But that's why I say take your time before the marriage fully, gets going, because as you go through this industry, even if you're just underwriting together and making an offer, you find out a lot about things, whether they're going to hold true to those mission, vision, and values. Yeah,
great. Yeah, and I like your idea of working with a team to kind of see, do some underwriting and kind of figure out before you get into like a partnership. That's kind of what we're doing now. We have like a team on Slack, and we're kind of going through the motions, seeing if these people are actually willing to go the distance as some other individuals that just say they are, obviously, compared to the actual ones that will. So I like that idea as well. Thanks.
Yeah. And then the last thing, kind of talking to you, that came into my mind is just making sure there's a clear line of job duties and kind of where that starts and stops. And because if you don't have that set out up at front, as more things come up, it's going to be tough to divvy them up. And you really want certain people to be responsible for certain buckets, so you don't have your hand in all the cookie jars, right? Because you get spread very thin. And so it's really important to have those conversations early. You're going to be in charge of this. You're going to be in charge of this. you're going to be in charge of this.
Yeah, definitely. We try to do that by everyone, kind of figuring out what everyone wants to do in each bucket, and then it kind of has, commingled. Everybody's kind of like doing different things, and I kind of getting spread a little thin on what I'm supposed to be doing because I have to kind of keep things on track. But obviously, this is fairly new, so we'll get things on track, I believe, if we keep working together and keep.
Can you see that, or do you see just one screen, or you see my next slide?
Your whole desktop with the slides on it. So while Kyle is setting that up, I would like to say that from trying to vet a partner, there's only so much you can do ahead of time. And one of the things that Kyle mentioned, which is really great about our business, is there is a lot of partnerships that are deal to deal. And there's no need for you to get into a permanent partnership with someone at first, when you can just do a deal with them. And it may take you one or two deals or several months of working with someone before you know if there's any conflicts. Oftentimes, you work great with someone until their back is against the wall, or there's some type of money issue or some disagreement over how the deal should be run. And you actually should look forward to having those conflicts, because that's really going to tell you more about who your partner is and how well the partnership's going to go. If you can work through those things, then and you want to form a long-term relationship, a company, so to speak, as opposed to working deal to deal, that's when you're really going to find out. So,
then what is the difference between deal to deal versus forming a partnership? Is there a contractual difference?
Well, as you know, Dennis, on every syndication, we set up two LLCs for the syndication, the managing LLC and the LLC that owns the asset. So deal to deal, you are as a general partner, you're in those two LLCs. But you may want to form a longer term relationship, as Kyle has a couple of brands that he's part of, and he mentioned that they have several people that he works with on those brands. So that would be more of a company and a more of a permanent partnership.
Okay, thank you.
Okay, perfect. Well, now let's get into raising for your first deal. And I remember raising for my first deal back in, I think it was 2018, and it was about $1 million deal for a 42-unit property. And I thought that I would be able to raise the whole thing by ourselves. Now, we did raise 900 of that 1 million, but the one thing I always say when you're raising capital, if you've never done it before, it's a different experience. And really, it's very different from multifamily real estate. They're two different things, right? Raising capital and then managing multifamily or buying multifamily, being a real estate investor. And I always say that you get to peek behind the curtains of people's lives when you raise capital, because this is people's hard-earned money, right? And life happens. And so when you're raising capital for a deal, you think you have commitments. Well, that family may be having a baby and that they're just not focused on that. Maybe they're buying a house and they need to show liquidity and they can't do that right now. Maybe they're traveling for a month. Maybe they have a death in the family, whatever it may be. There are things going on in people's lives where it affects the ability whether or not they're going to invest in a deal at that time. Maybe they just invested in 3 other deals and they're tapped out for the year, right? So commitments, verbal commitments, do not necessarily mean that you're going to get those funds for the first deal. And so I always tell people, raising on your first deal, if you think you can raise $1 million, it's likely going to be $500,000. That's not in every case. There's a lot of people out there that have access to very deep pockets and a stronger network. But if you're just getting started and you've never raised capital before and you don't have those networks, then I would say cut what you think you can raise in half, because you're going to get those types of answers. Okay. So first thing to think about, I read the book Who Not How by Dan Sullivan. I'm part of Coach, like I mentioned earlier before. And it's really a mindset shift is, who can help raise capital for you? Now, paying someone to raise capital is not something you can do directly per the SEC. And so there's other job duties that you certainly have to bring that person on for. But if your strength is not raising capital, like mine really isn't, although, I've raised on all of my deals, who can help you raise capital? Who does have a strong network? And maybe that is the partner that you're looking for to bring onto your team to work with, right? Again, make sure you talk to an SEC attorney, because you can't just pay someone directly for raising capital. But that might be something to think about, is you don't have to do this all on your own in this industry. In fact, if you're doing it all on your own, you're doing it the wrong way. This is a team sport, and in order to get things done and to get them done efficiently and effectively, you need to have a team around you. And so one of those people might be a capital raiser. Okay. Educate yourself. Very important thing when you're raising capital is to understand the business that you're in, right? You're taking hard-earned money from people, not taking, but you're requesting, raising that capital for your deals. So in this business, you have a much larger responsibility to those investors versus using your own money, right? When I first got started in single family homes, I'm just using my own money, and you don't want to lose your money, but if you want to educate yourself along the way, so be it. That's up to you. In this industry, when you're raising capital from other people, you need to be educated or have people around you that are educated, or else it's very irresponsible, right? Investing $1 million of someone else's money when you don't know what you're doing is a huge mistake. So the first thing to do is educate yourself in this business, or have people around you. Surround yourself with people who are already doing it. And then you're going to have education in order to speak to people intelligently about these deals, right? Even if you're raising capital for someone else's deal, you're going to get a lot of questions from investors. And so it's important to educate yourself. They're going to ask you about tax benefits. When are dividends? What is the business plan? What's the track record of the team? How do you know you can get those rents? And they're going to talk in terms that, if you're not educated, you're not going to know. And that's going to come off very easy, whether you know what you're talking about or not. So very important to educate yourself, listen to podcasts, listen to books, surround yourself with people that are doing it already, go to conferences and events. But, when I first got started, I guess I was lucky enough that I had an 1.5-hour drive each way to work. And I did that for 8 years. But during the 2 years that I had a job, or 1 year while I had a job and I was educating myself, I listened to podcasts, and I listened to them on 2 speed. And so I was driving 3 hours a day. So I was listening to 6 hours of podcasts every day, 5 days a week for almost a year. Right.
Can I ask a question?
And so, yeah.
And I don't know if you want us to interrupt you, raise our hand, whatever.
Yeah, go for it. No, absolutely.
So one thing that when I got into capital raising, my biggest challenge was that whenever I approached people with a 506c, that I had no established relationship with, they were very susceptible to work with me because I had no track record, right?
Uh-huh.
And just from your perspective, I mean, I'm beyond that now because I've had some successes and I align myself. But what kind of recommendations can you give to anybody who might be starting out or who watches this video later on? They want to get into capital raising, but they don't have any kind of track record to go against, and they come across a deal, they do the underwriting, and it turns out to be a good deal, and they want to raise capital for it.
Yeah, so 2 things there. Everyone is always going to have to get started in the business and say they've never had a deal go full cycle, or this is their first deal, and it's part of the growth process, right? Dennis, now you're at the point where you've done several deals, and so raising money is easier. That's a natural progression. We did the same thing. However, a couple things that you can do is, number one, invest in a deal passively yourself so that you can actually understand the pieces of a syndication, working with an experienced team. So you'll have a track record of at least investing in a deal. So you can speak about that. And then number 2, join a team that's already doing it maybe. And leverage their track record. Right. So if you're raising capital for a deal and an operator well, you vetted the operator, they have a strong track record. They're the ones that are actually going to be running the deal. So you can leverage their track record. Now, you'll still have some people that are, maybe will say, well, you haven't done a deal. So, you're not experienced yet. I'll wait till the next one. That's exactly what happened to us as well. But if you're not the one operating it, definitely leverage the track record of the person who is. Okay. All right, so educate yourself. That's really should be number one, really important in this business. Don't be greedy. When you're first getting started, people want to make millions of dollars right off the bat. There's so many pieces of the pie and it can get split very well and you can do very well. But when I got started, I didn't care what I was going to make on my first or second deal. I wanted to educate myself. I wanted to understand what the process of a syndication was like A to Z. And I knew I was learning. And so I was open to anything, and we didn't make a ton of money on our first deal, and that's okay. I learned a ton from that deal, and it's invaluable experience. And so that's part of the education. But in this business, when you're dealing with, we now buy $25 to $30 million properties, it's a lot of money. And it's important to remember, number one, go back to your goals, what your mission, vision, and value is, but don't be greedy in this industry. Have an abundance mindset. And then build your list early. I started basically building my list for raising capital the day I got in the business. Okay. And it took us 18 months to find our first deal, to close on our first deal, 13 months to find it. And I had been building my list for 13 months before I started raising capital. And that is why I was able to raise $900,000 on our first deal. If I would have waited to get a deal and then start talking to people, I wouldn't have been able to even raise 100,000, right? So what happens is when you build your list early, you start to show people that you're serious about it, right? So first we start a newsletter, then a meetup, then a podcast. And you don't have to go the educational route, but that's the platform that we chose. And people saw me progress. And because of that, it built trust. And that's why I got those investors. But 13 months of building a list, not just a month or even, when I got a deal, did I start raising capital. Okay. So you want to build your list early and always be raising. They always say, always be closing. You should always be raising capital, right? So today, when you're talking to people, you should be vetting people out, bringing people on your list, talking to them about the possibility of a deal, because you can't predict when your next deal is, especially when you're first getting started. You're going to find a deal all of a sudden, it's going to be go time. And if you have not been raising capital, well, you're going to be behind the 8 ball. Okay. So every time you have the opportunity, you're raising capital.
What were you predominantly sending in your newsletters when you first started out?
Yeah, at first it was, so the one thing that I had when I was first starting out was a little bit of imposter syndrome, right? And I think everyone goes through that where they're thinking, well, why should I be running a meetup, was my thought. What should I be, why should I be talking about something that I'm just educating myself on as well? But I made sure I was taking action on the things that I was learning. So I went through a course and I was taking action on those items. And so for the first 12 months, I was very cautious of only talking about things that I had actually done myself, right? So picking a market. So I picked a market. So I talked about the process of picking a market. And then I start talking about why I like that market, right? Because I can do that because now I have my market. So I want to vet or start introducing the Phoenix and Tucson market to my investors and talk about why we like it and all those things. I promote my meetup. And then I write a little bit of a blog on something that I had been through, like the process of picking a market or whatever it may be. But at first it was a very short newsletter. And then as it got built out, as my experience got more broad, then it built out even more. But you can talk about picking a market, finding a partner, for example, underwriting a deal, building a broker list, talking to brokers, submitting an LOI. And so those things happen over the course of 3, 6, 9, 12 months. And so that's how I went about it. Real life situations. I already talked about this. You get a peek behind the curtain of people's lives, whether they're having a baby, they need to show liquidity. So raising capital is not an easy process. It's really different than real estate investing. And so if you haven't been through it, it's always good to go through that. And you'll understand what I'm saying if you raise capital, but always cut your initial thought of what you can raise in half is my rule of thumb. Keys in the follow-up. You're going to be told no, or, hey, I'm on vacation this week, or I haven't had time to look at it yet. You've got to follow up. You have to have some type of system, whether it's in, when I first started, it's in Excel. Now we've got a CRM for this kind of stuff that we that we utilize, but you have to follow up with people. Sometimes they're just too busy and they haven't had a chance to look at it and they want to invest. And after you follow up a few times, they take a look and they do invest, right? But the first no doesn't always mean no, or maybe an email that isn't answered or a phone call that isn't answered does not mean no. It's all in the follow-up. It's, you know, it's the key for all sales. It's all in the follow-up, and that's what raising capital is all about. And if you're not following up with people, you're likely going to raise much less than if you would. And then as for referrals, this has been our biggest source of growing our investor database. Is once you do raise capital and get started, always ask for referrals. Hey, do you know anyone else that may be interested in this type of thing? Even if it's someone that says no, hey, right now is not the right time for me, I've got this going on. Do you know anyone else that might be interested, right? And obviously, whether you're doing a 506B or a 506C, whether that person can invest in that first deal or not will be a little bit different. But that's how I build my list up all the time now, is I ask for referrals. And after you have a couple successful properties, it's even easier to ask for referrals because now you've returned some capital to your investors, you've had a successful exit, and you ask for referrals, it's much easier. But always ask for referrals when you're raising capital. We doubled our list from that one key point alone. Okay. That's it for my raising capital, kind of raising for your first deal. So I'll open it up to questions for that. Any questions on raising capital?
So I'll make another comment, Kyle. I like what you said about whatever you think you can raise, cut it in half. And my experience is if it's your first raise, you don't be surprised if you only have a 1 or 2% success rate. Mm-hmm. And so if you know that you need 10 investors, you need to extrapolate that into how many phone calls you need to have. And if you haven't been building a brand for 6, 9 months, maybe even a year online, don't expect that you're going to raise very much money with emails and online presence. People need a follow-up. People need to have a personal connection, and they need to hear from you. And if you don't, they're going to feel like you really aren't that interested in them. And so if you you may have to make 200 or 300 phone calls in order to get the raise that you need. And that's why we've offered for so many of you to participate in the raises here on the GOB network, where most syndicators will want you to commit to at least $500,000, $1 million. You know, we don't care how much you raise. We just want you to start practicing, because this is a game of practicing. You need to practice over and over again.
Yeah, well said, Jim. I completely agree with that. And that's great that you offer that for newer investors, because it's like I said, it's a different ballgame when you're raising capital versus real estate investing, and as much practice as you can get. Just picking up the phone and talking to people, if you're an introvert, it's not always easy, and how those conversations are led and how they go are not easy. So the more practice you can get from that, absolutely is great. Philip, you had a question? Oh, you're on mute. You're on mute, Philip. Yep.
Yeah. I've been saying that I was muted, and then I tried to unmute and I was still muted for some reason. Anyways, so I also have the imposter syndrome, and I was recently invited onto a podcast, but I haven't agreed just because I don't feel like I have the experience to share anything, you know, with this audience that Whitney Sewell has. And so I haven't.
Gotcha. Okay.
Yeah, so I don't know if I should try for it or not try for it. In such a case, I've only got a one apartment deal under my belt. So what do you think? Should I go for it?
You 100% should go for it. And here's what I'll tell you. There are thousands of people that listen to Whitney's podcast, right? I've been on it a couple times, and you have no clue on where every person is in their journey and in their path. And if you've done one apartment building, I guarantee you are further ahead than a lot of the people listening. And you can share your story on how you got started, because that's pretty inspirational that you even have one apartment building, right? So that's a huge accomplishment. So I think you need to pat yourself on the back a little bit for that, for sure, because it is a huge accomplishment. But there's always going to be someone that is behind where you're at that can utilize the experience that you have so far, whether it be very little or a lot, that can help them along in their journey. So, you know, the one thing that helped me get over kind of imposter syndrome also is don't think about yourself and don't think about, oh, I'm an imposter. Think about the value that you can add to someone, right? You have closed on an apartment deal, so that will add value to someone. So it's switching your mindset a little bit there, but absolutely you should go on Whitney's podcast.
Yeah, I want to add to that too, Philip. Kyle said that one way he overcame the imposter syndrome. Well, you know, I started this network a little over a year ago. Very hesitant. I always turn down every podcast that I was asked to be on. I still turn down a lot and still suffer from imposter syndrome every single day. We all feel, if we're introverted, if we came from, you know, maybe a poor background or uneducated background, like we don't have anything to offer. And you guys have heard me say many, many, many times before that if you're in this space, you know more than 90% of the public, maybe 98% of the public, about apartment investing. And the most impactful stories are the people that were able to go from 0 to 1. The most impactful stories. How many people attend these conferences? Millions of people a year attend these conferences and never, ever take action, never get their first single family rental, never get their first apartment deal, never become a limited partner. So you guys really, really need to accept those offers and don't worry about how you feel. You're going to be nervous. I continue to be nervous. Just realize that and also realize that you have a lot to offer. So thank you, everyone, for that has to leave because it's top of the hour. Appreciate it. So
thank you so much, Kyle.
There's only one way to grow. It's to get out of your comfort zone, right? And so you've got to get out of it.
For sure.
Thank you so much,
Thanks,
Kyle.
guys.
Appreciate all the knowledge sharing. Does anybody have any other questions?
Yeah, I do. Kyle, just so you mentioned that it's about building relationships and it's about 13 months building relationship before your first deal. But what I'm trying to find out is, have you, or what percentage of your database individuals who you have no relationship with that you just connected with, and also what sort of conversations you had with those types of individuals?
Sorry, so none of the individuals that invested in my first deal were people that I didn't know, right? Because we did a 506B. So we had to build those relationships. We do 506Cs now. So we do have people that will invest in our deals that I've never met. But it is few and far between, to be honest. I think a lot of people think with a 506C, they'll blast it out to everyone and they'll invest in the deal because it's a good deal. But it really comes back to knowing, liking, and trusting the sponsor and the person operating the deal. I'm not going to put $100,000 with someone that I've never met and don't know, right? And so I have spent the last 4 years building up my reputation and all those things. It's a little bit different now than when you're first getting started, but you know, I have 7,000 people on my list. I have 500 people who have shown interest in investing, and I have essentially had 100 people that invest, right? So will those 7,000 events eventually? Maybe. But you know, that's why it's important to build out your network, because it's just like anything, right? The more deals you underwrite, the more deals you're going to find, right? Because it's process of elimination. It's a math game. But the math in this industry and raising capital and finding deals, I mean, you're in the 1%. You know, 1 to 2% of the deals you look at, 1 to 2% of the people you talk to are going to invest in your deals, especially when you're first starting out. I hope that answers your question, Kevin.
So thank you, guys. Kyle, thank you so much for being a guest and coming on and helping us out with all the great information today. Thank you, everyone, for enduring the Zoom bombing. We'll report that to Zoom right away. I've got another meeting to jump to, so we're going to have to end this one up. Really appreciate you guys being here.
Thanks,
Thank you,
everyone.